Ever look at the stock market and feel like you're trying to read an alien language? Well, you're not alone. It's not just symbols and numbers flying around like UFOs, it's a whole new world of opportunities. But hey, don't fret. We're not about to send you off into this financial galaxy without a translator. Welcome to the universe of investing, a place where terms like bulls and bears are not part of a wildlife documentary, and where dividends are not just a fancy term for splitting the dinner bill. Today we're going to talk about a certain star in this constellation, the ETFs, or exchange-traded funds. These are like the friendly extraterrestrials of the investment world, here to make your journey a little less daunting and a whole lot more profitable. So buckle up, because we're about to decode this alien language together. Let's make this financial universe a little less intimidating and a lot more rewarding. ETFs, or exchange-traded funds, sounds fancy, right? But it's simpler than you think. Picture this. You're at a party, and instead of choosing one type of food, you decide to sample a bit of everything. That's essentially what ETFs are in the financial world. They're investment funds traded on stock exchanges, much like individual stocks. But here's the kicker. ETFs hold assets such as stocks, bonds, or commodities, which means they offer you a diversified portfolio. This is the beauty of ETFs. They allow you to spread your investments across a wide array of companies and sectors, reducing the risk tied to a single company's performance. It's like having your investment cake and eating it too, but without the risk of a stomach ache. In other words, you're not putting all your eggs in one basket. In simple words, ETFs are like a buffet. You get a little bit of everything. Ready to jump into the deep end? Hold your horses, start small. Think of your journey into ETF investing like learning to swim. You wouldn't want to dive into the deep end without first learning how to float, right? Well, the same logic applies here. Starting small allows you to dip your toes into the market without sinking your entire financial ship. In the beginning, your goal isn't to make a fortune overnight. Instead, focus on understanding the dynamics of the market. How do ETF prices fluctuate? How does news impact your investments? These are questions you'll learn to answer with a smaller, more manageable portfolio. Starting small also minimizes potential losses. Let's face it, even the most successful investors have made losses. But by starting small, these losses become valuable lessons rather than devastating blows. So before you go all in, remember this. Rome wasn't built in a day, and your investment portfolio won't be either. Remember how you hated homework in school? Well, in investing, homework can make you rich. Now don't start groaning just yet. This isn't about quadratic equations or the periodic table. It's about getting to know the world of exchange-traded funds, or ETFs. Think of it this way. Would you buy a car without first checking its mileage, safety features, or whether it fits into your budget? Probably not, right? The same principle applies to investing in ETFs. It's crucial to understand the market trends, how different ETFs have performed in the past, and what they're projected to do in the future. You wouldn't want to invest in an ETF that's the equivalent of a gas-guzzling, breakdown-prone clunker, would you? So, before you put your hard-earned cash into any ETF, make sure you've done your research, understand the nitty-gritty, and make informed decisions. So, roll up your sleeves and get ready to do some homework. Ever heard the saying, "Don't put all your eggs in one basket"? This old adage rings especially true when it comes to investing. Why? Because diversification is key. It's like going to a buffet and sampling a variety of dishes rather than just loading up on mashed potatoes. Let's break it down. Diversification is the practice of spreading your investments across different types of assets to reduce risk. Think of it as a safety net for your hard-earned money. If one investment takes a nosedive, others may stay afloat, cushioning the fall. And here's where ETFs strut onto the stage. ETFs, or exchange-traded funds, are like ready-made diversified portfolios. They typically track a specific index, sector, or commodity containing a mix of different assets. So by investing in a single ETF, you're effectively spreading your eggs across multiple baskets. In the unpredictable world of investing, diversification is your trusty safety gear. So diversify, because no one likes a broken egg or a broken bank account. Investing isn't just about making money, it's also about saving money. Now, isn't that an interesting twist? When it comes to ETFs, understanding the costs associated with them is crucial. You see, ETFs are like that fancy restaurant downtown. Sure, the food is great, but oh boy, those add-ons on the bill can sting. Similarly, ETFs come with their own set of add-ons like management fees. These are the costs that fund managers charge you for their expertise and services. And just like you'd scout for a restaurant that gives you the best bang for your buck, you should do the same with ETFs. Look for funds that offer you good returns but at a lower cost. And don't be fooled by the seemingly small percentages. A management fee of 1% might not seem like much, but when your investment grows, that 1% can become a sizable amount. So, be cost-conscious and choose wisely. Remember, every penny saved is a penny earned. Investing isn't a sprint, it's a marathon. Let's take a moment to really let that sink in. Picture the stock market as a winding road, full of ups and downs, twists and turns. It's tempting to jump out of the car during those steep downhill moments, right? Resist that urge. That's where patience comes in. You see, when it comes to investing, time is your best friend. The longer you stay invested, the greater your potential returns. And those short-term market fluctuations, they're the potholes on your investment journey. Don't swerve off the road because of them. Instead, buckle up and stay the course. Remember, no investment strategy guarantees instant gratification. It's about sticking to your plan, trusting the process, and letting the magic of compounding do its work. After all, even the most majestic oak tree started as a tiny acorn. So stay patient because good things come to those who wait. Investing is a bit like gardening. It needs regular tending. Now imagine your portfolio as a garden of diverse plants, each representing different investments. Over time, some plants grow faster than others, and if left unchecked, your garden might start to look a little lopsided. That's where rebalancing comes in. Rebalancing is the process of realigning the proportions of your portfolio to maintain your desired level of risk and return. If certain investments have grown significantly, they might now represent a larger portion of your portfolio than you originally intended, increasing your risk. To rebalance, you'd sell some of those investments and buy more of others to get back to your original allocation. Rebalancing isn't about chasing the highest returns, it's about sticking to your investment plan and managing risk. And just like tending a garden, it's something you need to do regularly, not just once in a blue moon. So remember, a well-tended garden is a blooming garden. When it comes to investing, keep calm and carry on. It's an age-old adage, but one that holds true in the world of ETFs. Picture this. The market takes a nosedive, and you're watching the value of your investments plummet. It's easy to let panic set in. But here's the twist. Panic is not your friend in this scenario. This is where your investment plan comes into play. You've done your homework, diversified your portfolio, kept an eye on costs, and been patient. Stick to this plan. Market downturns are, more often than not, temporary. They're like roller coasters, scary when you're on them, but eventually the ride ends and stability returns. So, when the market gets rough, remember to take a deep breath and resist the urge to panic sell. In the grand scheme of things, these are but mere blips on the radar. Remember, the only thing we have to fear is fear itself, and maybe spiders. So there you have it, 10 tips to help you start your ETF investment journey. We've covered everything from understanding what ETFs are to starting small and doing your homework. We've talked about the importance of diversifying your portfolio, keeping an eye on costs, staying patient, and rebalancing regularly. And of course, never, ever panicking. Remember, investing is not a sprint, it's a marathon. And like any marathon, it's all about pacing yourself and keeping your eyes on the finish line. So don't be afraid to take that first step. It may seem daunting now, but with these tips in your arsenal, you're more than ready to tackle the world of ETF investing. And hey, if you found these tips helpful, why not share the wealth? Recommend this video to a friend, or better yet, start an investment club together. Make ETFs the new book club. Don't forget to hit that subscribe button because we have a lot more decoded alien language coming your way.